Fed Chair Jerome Powell apparently had a conversation with Ukrainian President Volodymyr Zelensky back in January, except it wasn't Zelensky. It was two Russian hackers who were using AI and voice faking tools, if you will, to spoof an interaction between the head of the Federal Reserve and the Ukrainian president. Let's ignore the fact that there are some significant questions over Fed security with their communications policy that need to be addressed. What we care about from that conversation is that back in January, Powell had said to fake Zelensky, and again, this was an official meeting. Powell thought he was literally talking to the Ukrainian president, right? Powell says to Zelensky, we're probably going to be at 2 more rate hikes, and then we'll see if we need to do 1 more from there, and we'll have to determine how long we'll keep rates at an elevated level. So if that was back in January, let's think about what the Fed's already done. The Fed raised rates in February. They raised rates in March. The market right now is toying with the idea that maybe we have 1 more rate hike here in May, potentially 1 thereafter. So Powell, in effect, has been following the script that he himself had outlined pre-SVB. So if SVB and Signature Bank and now First Republic have tilted the risk to maybe the Fed can't raise rates as much as they would have liked to, which we see through Fed hike odds and their evolution since the beginning of March. Perhaps the market's seeing this as a sign, well, even without SVB and Signature Bank, the Fed was thinking that it was getting pretty close to the end of its hike cycle as is. And so given SVB and Signature Bank having happened, we now think the Fed is close to the end of their hike cycle. So does that beg the question, even though the market's been toying with a potential hike beyond May in either June or July, could that mean that next week is a one and done? If you really read between the tea leaves, if you pull out your Fed criminologist playbook, like, doesn't that kind of sound like in a pre-SVB Signature Bank world, the Fed was setting up a scenario where May could have been the final rate hike, and the odds have been tilted then to this being the final rate hike, given the banking episode?
So, to quote Tony Soprano, I have a couple of 3 things here. So the first thing is, this is not a controversial thing that Powell told fake Zelensky. The markets were already there. In fact, the entire basis for the November, December, January risk rally was that the Fed was believed by markets to have essentially arrived at the end, that the path forward was already in place. It was the February economic data that jettisoned those expectations. So he didn't tell Zelensky anything the markets didn't believe, hadn't believed for months at the time he said it, hadn't occurred in markets for months at the time he said it. Really, the Fed and the markets had come to this general understanding, we know, based on the summary of economic projections that was released in December. Peak rate of about 5. That gave us exactly what he told fake Zelensky here. So that's the first thing. Second thing is, of course, this conversation occurred exactly in the sort of tail end of that narrative. And of course, come February, there was that run of impressively good economic data, punctuated very early in the month by that NFP report that was, if memory serves, something like double the expected amount. And we ended up with a run-up in rate expectations to a peak of 5.5. And Fed rhetoric turned a lot more hawkish because the data seemed to call for it. That was what SVB happened against the background of. And we then went aggressively lower. We had the Fed's and the FDIC's and the Treasury's fighting efforts. And here we are. Rate hike expectations collapse. Aggressive rate cuts start getting baked in. Then the firefighting efforts appear to take hold. And now we're essentially where we were at the start of the year. We're again looking at a peak Fed rate of about 5 and looking at a path thereafter that's very comparable. So essentially, we've erased nearly a month of back and forth, but broader, we've erased almost the entire first quarter plus here in terms of expectations development. We're basically where we were at the start of January.
We find ourselves. Finally, yeah, go ahead. Sorry.
Yeah.
You have the threes. Sorry. The Sopranos threes. Sopranos threes.
The third thing here, and the shortest of them all. The market is convinced that this is going to be a one and done. If we look at what is currently priced into markets, I was just running these numbers just a bit earlier today ahead of macro money, just to make sure that we have the latest numbers there. And we're looking at a 90% chance of a 25 basis point hike. 23 of the 25 basis points are already baked in. If you look at then what happens in June, 25% that you're going to have that hike occur then. So it's not as though we're looking at two hikes. It's that we're unsure whether we're going to get it in May or in June by a very narrow margin, with the odds-on favorite overwhelmingly May. And then, of course, if you get it in May, well, then June is off the table. Because what we see is that currently the Fed rate is at 4.8 effectively in the middle of the 4.75 and 5 range. And the peak is at just over 5. Any way you slice it, whether it's June or it's May or it's July. And then from there, you have cuts already fully priced for December. So one cut fully in there. So
I mean, I would actually argue
there's controversy here.
I would argue more than that. The December rate for Fed funds is right now implied 4.61%.
Yeah.
The peak is expected to come in July at 5.105%. So that's basically 50 basis points. Granted, that spread has narrowed the last few days. I think that's one of the important developments today.
Yeah.
We mentioned on yesterday's show how that spread had widened out to about 65 basis points, pricing in potential for 2+ cuts. Now we're only down to basically 2. And if that gap continues to narrow, that's a sign that there's some confidence here in the market.